Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Bill Bennett, the CEO of Innovative Foods Group. After spending a number of years working for big companies like Wal-Mart and Kroger, Bill became the CEO of Innovative Foods in early 2023. Since that time, he's been leading an aggressive business improvement plan that has started to bear fruit. In this conversation, we covered what initially attracted Bill to the company and to the CEO role, where Innovative Foods plays within the specialty food subsegment of the massive food service industry, the divestitures the company has made to simplify the business, the secular tailwinds behind the specialty foods category, and what the company needs to do to hit its EBITDA and revenue targets. For full disclosure, I am not an IVFH shareholder. And without any further ado, here's my conversation with Innovative Foods Group CEO, Bill Bennett. As always, we will start this podcast off at a pivotal moment in the company's history. Bill, after running the large e-com business for Kroger, you decided to take the CEO role at a much smaller company. I'm curious what you saw initially that attracted you to Innovative Food Holdings.
Yeah, thanks, Ben. Appreciate the question. It definitely a big transition. So I was running the e-commerce business at Kroger, which was about a $10 billion P&L. When I moved here to the CEO role at Innovative Food Holdings, it was about an $80 million company. So definitely shaved a few zeros off of my area of responsibility. But I was really looking for something that I could fully own end to end. And I think, after 20 years in kind of large companies across corporate America, you get that sense of, I really could do this on my own, and I want to be able to make my leave my own stamp on something, right? I'd worked for Kroger most recently, as I mentioned, but then before that, I was with Walmart for 8 years, and then with General Mills and S.C. Johnson for a number of years before that. So I'd done consumer packaged goods, I'd done retail, I'd done e-commerce, I'd done bricks and mortar, and was just excited about an opportunity to do something on my own. Now, that said, I looked at a lot of startups and kind of other interesting job opportunities. This one really piqued my interest at IVFH because the company had such great bones to it. It had a profitable food service business in place for its entire existence for 20 years. And over the last 10 years in particular, there have been a lot of decisions to lean into more of a consumer business that had lost money hand over fist, and it essentially covered up the profits of the food service business. So I felt like in a fairly short period of time, I'd be able to sort of clean up the entity structure and focus in more on those profitable businesses, and therefore be able to really drive profit growth for the company fairly quickly. So that was sort of my story of coming over to IVFH.
And now that you've been in the role for about a year and a half, I'm curious about what has surprised you, either good or bad, relative to what you were expecting when you were first learning about this opportunity.
Yeah, so on the good side, being a brand new CEO, I really had no idea what to expect in terms of working with a board. And we just have a fantastic board of directors. I think I would argue probably one of the best boards across all of the microcap sphere. We've got very experienced capital markets guys. We've got our chairman has deep food experience, James Pappas. We've got more than $500 million in capital sitting around the board table, with most board members owning or running a fund of some sort. And so the board actually owns more than 50% of the shares outstanding. So you've got investors and partners around the table that really want the business to grow over the long term and are willing to stake out a strategy that takes time to develop. And I think as a CEO, there's not much more you could ask for than that. So that's on the good side. On the bad side, I'm not sure I realized quite how dire the financial situation was of the company when I came in. We were burning cash hand over fist, and in a pretty tough spot when I got here. And so it was really kind of like a, four-alarm fire from day one, just trying to right the ship and make sure that we were going to be headed in the right direction. I think we made a ton of progress since then and are much more stable and healthy state than at that point. But that was definitely a surprise. But it's, overall moving to a smaller company is fun. I think, far fewer resources, far less data at your fingertips. You wear a lot more hats than you do at a big company. But that's part of the fun is that you act more like a general manager and you work across silos more easily and you get to really one of our phrases we use internally is you get to eat what you cook, which sort of aligns with our food focus, right? But the work you do every day, you yield the rewards from it, or the struggles from it the next day. And it's fun to have that kind of accountability and be able to really drive things forward without the natural bureaucracy and red tape that comes with a larger company.
I think it would be fun and insightful to dig in a little bit to that four-alarm fire that you stepped into. So you were coming from a $10 billion P&L business that probably had fires of sorts, but they weren't existential fires,
Yeah,
right?
yeah.
And so just talk us through, what did you do? Like actually, I mean, there's the outcome of what you've accomplished that people can see in the financials, but what did you do? How did you think about leading people in that environment? I'd love to hear the trials and tribulations you've gone through as you've had to deal with something that was maybe a little bit less stable than you'd hoped.
Yeah, so I've actually studied a lot of companies that have gone through this type of a phase. In particular, as I was entering the company, I needed just a few more data points because I hadn't sort of been in this situation before. And one thing that's common among them is many times the employees don't realize how dire the situation is.
Mm.
And that's a problem because then they're not sort of empowered to make the right decisions every day when they don't realize, that you're really clawing for cash every single day. So the first thing I did was just completely go, you know, candid with the team and help them understand the situation and what needed to change. I was confident that we'd be able to turn it around. So it didn't feel like a scary discussion to me. It felt like, we just needed, like I said, to empower people to make the correct decisions day in and day out. First thing I did is we had a bunch of open headcount on the day I joined, and so we froze all hiring and said we're just going to have to figure it out with the people that we have in place today. And at least one of those positions was an executive position, so that it represented some significant savings for us to not backfill the role that had been recently vacated. Then we immediately looked at pricing and margins. So if you look in detail at my background, I did pricing for a long time at both Walmart and General Mills and SC Johnson. So like a deep pricing experience, and so it's a space I felt comfortable in. And as we dug in, we realized that in the face of all the inflation that had happened, so I joined in March of last year, right? So kind of right in the middle of raging inflation, we hadn't hardly taken prices up. And
Mm.
so we've been just absorbing all these price increases. Our margins were down 400 basis points year over year in the first quarter after I joined. And so that felt like a good, easy place to start. We had, all the industry data backed up our story. We didn't have to like tell some, convoluted story about why we had to raise prices. I think everybody was understanding when suppliers were raising prices at that point. So we made some pretty quick changes on pricing, and that led to a huge margin upswing in the second quarter I was in place, and definitely helped cash flow from the get-go. And the third thing is we just really focused a lot on expenses. So, this is a small company, and so I told our expense team, our payables team, that I wanted to review every single check that went out the door. And so for the first couple months, it was literally like, why are we spending $250 a month on lawn care at our XYZ warehouse? Because I've been there and it's like 300 square feet of grass. That doesn't make it. I can send my son out there on an airplane probably for cheaper to cut the grass than what we're paying somebody else to do it, right? So, I mean, we went to that level of granularity. Another fun little story was that we had, when I visited what was our headquarters building in Florida. We've since sold it off, but we had an entire room that did nothing but house the biggest printer I've ever seen in my life. I mean, this thing was like 10 feet long and gigantic. And I started asking questions about it. First of all, what do we pay for this thing? And found out that we were paying $1,800 a month in a lease to have this printer. It's like, okay, well, what in the world are we printing in this digital world that we all live in, right? What do we need that kind of a printer for? And the answer was that we needed it for food shows. And so I started digging in with the sales team, like, how many food shows do we go to a year? Oh, like maybe 2 or 3. And we hand out these flyers. Yes. Does anybody else hand out flyers? Well, not really anymore. They mostly hand out, a one-page flyer with a QR code. They don't hand out whole catalogs like we're handing out. Well, maybe we should change that, right? So we ended the lease. We went from, lease plus printing costs about $30,000 a year. We literally bought a printer from Sam's Club and, for $350, and we'll probably replace it every 6 months when it runs out and when it dies, and we'll be fine. So anyway, like that kind of granular management, I think, is necessary at the beginning to save expenses, but also to just set the tone, right? Like we weren't gonna spend money unnecessarily. We were gonna be smart. We also didn't cut off our nose to spite our face. I mean, we spent money on some things that were important in those early days too. But that was kind of how we handled the early times to get through that tough period.
And if I'm thinking about the things that you were focused on initially, you mentioned the food, the consumer business was losing money pretty rapidly. I mean, just diagnose what was going on there, and then bring us up to speed on where that is to like what's been remedied and where you are in the journey of fixing that side of the business.
Yeah. So, while I have a lot of e-commerce experience, I've never like tagged myself as an e-commerce guy per se. Like I think of myself as a general manager that could work on any kind of number of different businesses. And so, but I definitely have an e-commerce background in my most recent experiences. So I was very eager to get in and see if I could do something with the consumer e-commerce business. So it was igourmet.com and mouth.com were the two main websites that we owned. And so, in the first 3 months, we spent time really deep diving into all the customer metrics on those two businesses. And, if you've ever studied e-commerce before, the metric that matters more than anything is your cost to acquire a customer divided by the lifetime value of that customer. I guess actually the opposite. It's the inverse of that ratio, lifetime value divided by cost to acquire. And really where you should be is anything above a 3. So if you have 3 times the lifetime value that it costs to acquire a customer, then you're going to be cash flow positive. That's kind of like the rough math that people use to evaluate a business. And that way you'll be able to just indefinitely scale without constantly plowing in cash. We were spending about $25 per customer that we were acquiring into those businesses. And on that first order, we would only make $20. So we'd lose $5 immediately on the first order, which you'd say normally, like, I don't mind doing that if I'm building a long-term loyal relationship with a customer. But our problem was that only 5% of new customers ever repeated, right? So the math on that lifetime value to cost to acquire was just horrendous. And so we spent those first 3 months, once we understood that, saying like, man, is there anything we can do to improve that repeat rate? So we tried introducing, like, iGourmet was mostly gourmet cheese. So we tried introducing some high-end meats. We tried, pushing some produce. We tried, like, could we scale it out to like more of a holistic gourmet site that would have more purchase occasions to it than just gourmet cheese? And over a couple months of testing, the very quick answer was no. Like, we were too known as a gourmet cheese site. And, we actually went back and did the math. So these two businesses were purchased respectively in 2018 and 2019. So we're doing this analysis now in the middle of 23. So in 5 years, the company had lost $12 million on these two businesses, right? So for a company our size, it's just like mind-bogglingly expensive. And the other like interesting data point here is we only had 9 million in outstanding long-term debt. So we literally could have had no debt been a debt-free, profitable company at that point if we hadn't had these e-commerce businesses. So, we then took all our analysis and looked forward 5 years and said, if we could figure this out, how long would it take us, and what would be like the business model, the profitability level of these businesses 5 years out? And it just didn't look any better. It looked like it was going to take us another 10 to 15 million in investment in terms of losses over 5 years. And then, we would have gotten the business to like 30 to 35 million in revenue and be like barely squeaking out profit. So it's just not worth it. It's not the right way to allocate time and capital and resources for a public company. And so we decided to sell it off. So we put on the market in November, December last year, and then we just closed the deal a couple weeks ago. So we're completing the transition services agreement now with the buyer of the business, and we sold it for $700,000 in cash and about $350,000 of assumed gift card liability. So about just over $1 million in total deal value. And the guy who bought it's exactly what I was hoping for, which is somebody who has a broader gourmet business and that they can plug the cheese business into. Sure. And they'll face completely different dynamics to the business model than what we face, and they find value in it, and where we didn't, right? And so it was sort of a good win-win, I think, for everybody. But I'll just add on to my long story now of saying that the timing could not have been better, though, because we just announced also a couple of weeks ago that we've signed on a brand new business line for us. So we've got a top 10 retailer for whom we're going to be managing their gourmet cheese assortment. Mm-hmm. And so I think we're going to end up with like 10 days between when we finish the transition agreement on iGourmet and when we actually kick off this retail business. So the utilization of the warehouse is going to remain. All the people keep their jobs. We're literally using the same capabilities, the same sourcing relationships, a lot of the same equipment to just transition from a consumer business where we lost money hand over fist to a retail business where we're going to make a good, healthy return. And it's just thrilling to see kind of the whole company change overnight from doing these $100 gift baskets to doing, thousands of pounds of cheese a day, heading out the door. So pretty excited about the new business, and it's going to be pretty game changing for us as a company.
Well, it's certainly been an interesting 18 months for you, as you've gotten your feet wet at this company. I want to dig into the business, but I don't want to leave the comments you made about the board without digging in a little bit there. There's been a fair amount of turnover in the board. You talked about the chairman. I'm just curious, there's a lot of intellectual horsepower there. There's some capital behind it, but I'm just curious about what you think the newer members and the board is bringing to the table today that's been really helpful to you as a new CEO.
Yeah, so 3 board members have joined since I joined. I was one of them. I brought on then a guy that I worked really closely with at Kroger named Brady Smallwood as my chief operating officer, and gave him a board seat as well. So he and I have such a great partnership. We worked together at Kroger for nearly 3 years. Before that, we worked together at Walmart for a bunch of years too. So he's reported to me on 3 different teams and worked alongside me on a 4th. So we've kind of got a shorthand that we use to tackle problems together now. And having him on board has just been instrumental in being able to sort of extend my own influence and have the right trust and confidence that he's going to drive forward projects for us. Everything we just talked about on the iGourmet business has all been driven by him. All the analysis, all the strategy work, the entire sale process, all the legal, everything has been Brady driving that forward. So I'm incredibly grateful that he kind of took the risk to come along with me and on this journey at IVFH. So he's been game changing. And then we brought on a guy named Denver Smith, who is an activist investor. He wrote a letter to the SEC just probably 6 months before I joined, outlining the changes that he thought needed to happen at the company. And man, he'd been a shareholder for a decade, so he's not a short-term investor trying to turn a quick profit. He would really like to see us succeed, and he's just an awesome guy. And so he's been a fantastic partner as well. And I think this goes for all the board members, but I've just been so impressed that like they're all there to partner with me, right? Not to tell me what to do or to, push their weight around or anything like that. I've really just got a great group of people who are willing to help us build for the future, which is a pretty exciting group to work with.
Well, we've certainly talked about the past and what you inherited, and I think this would be a good time to talk about this business and what the future can look like for you and this company. So, for people who are new to the business, maybe just describe where this company plays within the massive specialty food subsegment of the food service industry.
Yeah, so let me start with food service first. So it is any food that you buy out of home that's not a grocery store is coming from the food service industry, right? So the biggest players here are Cisco by a long shot. Second is Performance Food Service Group, and then third is US Foods. So I say those because you might hear me mention them here in a moment, but those are kind of the biggest players in the overall food service market. But I look at them like, to borrow from my own experience, like the Walmarts of food service. They specialize in selling things that everybody wants at bargain basement prices, right? The very lowest cost they can get to. But what that means is that, um, you would never go to Walmart to buy like a very specific speaker cable or something like that, right? I mean, in the day you would have gone to something like a Radio Shack. Today you go to Amazon probably to buy something like that, or to Best Buy maybe. But you wouldn't expect Walmart to carry everything. They carry like a decent assortment across most categories, but they specialize in breadth, not depth in each category. And so these food service providers are much the same. Like, you'll buy a restaurant would buy their key like commodities and basic goods from there, but really every single restaurant is going to have a portion of their offering that they can't get from one of these. They're called broadline distributors.
Mm.
And so that's the role that specialty food service plays in the entire industry. It represents about 20 to 30% of overall food service. So it's a meaningful size. It's hundreds of millions of dollars, and hundreds I should say tens of billions of dollars of the overall market. It's gigantic. So our role in all of that then is that any specialty goods distributor struggles with the idea that the stuff by definition doesn't turn super fast, right? So any specialty foods distributor is choosing the top 2,000 to 3,000 items that they can reasonably carry to try to make the math work for actually owning the inventory. But you end up with this very long tail of assortment that nobody can carry because it doesn't turn fast enough. And that's kind of where we come in. So we essentially think of us as a marketplace for specialty goods where we connect lots of small purveyors, small manufacturers, small ranches, farms, fishermen into a single platform to sell their goods on a national basis through the US Foods, Cisco's, and Performance Food Service Groups of the world, right? So each of those have some form of a marketplace where we operate as a seller ourselves and are essentially contracting back with these other providers to ship stuff directly to the restaurant. So the flow is that, Joe Schmo's restaurant is a customer of US Foods. They go on the US Foods site, they find whatever tricolor quinoa that they're looking for that's on their menu. US Foods doesn't carry it, but they can order it to be shipped to them on the US Foods platform. That order gets routed to us and in turn gets routed to the distributor that we found who carries that product. And that distributor then ships it on our FedEx account directly to the restaurant. So it really is like a super capital light business model where for that core business, we don't own warehouses, we don't own trucks. It's really technology driven. We have a technology stack that manages all of the order flow, all the invoice flow, and all the payments back and forth with very few touches. And what that means is we can also grow it and scale it without much investment at all. So And when I talked earlier about the good bones in this business, this is what I was referring to. I think with all the focus there has been on consumer e-commerce over the last decade, there hasn't been as much focus on, real material growth in this piece of the business. And that's where we're really going to hang our hat going forward. So that's kind of the core of the business. There are other pieces that we've bolted on over time. So about a decade ago, we bought essentially with a vertical integration play, we bought our biggest vendor, who was Artisan Specialty Foods in Chicago. So they continue to be a large vendor into this drop ship platform that I've already described. And then we've sort of picked up some other interesting customers over time. So we do a very large business with Gate Gourmet, which is an airline caterer. You might have seen their trucks pulling up to your airplane.
Sure, yeah.
We do about $10 million with them, where we're actually physically shipping food to their kitchens all across the country. We do business with LSG Sky Chefs, which is a competitor to Gate. And then there are other places where sometimes we do actually take ownership of the inventory and ship it out where it makes sense for us to control the flow better. So anyway, those are kind of the key businesses. The one we announced a couple of weeks ago, this retailer, is going to be fascinating because now the throughput on our Pennsylvania warehouse is going to grow exponentially because we've traded out the e-commerce business and now we've got this new retail business coming in, and because of that, we're actually putting in some significant automation and machinery that's going to make our labor costs per unit go to the floor and help us do the kind of volumes that we need to at the speed we need to serve this retailer well. So lots of interesting pieces of the business going forward.
Sure, there's a lot swirling around. If you had to distill it in terms of how you would describe the core competency or secret sauce. You've described a sourcing element. You've described like a two-sided market of sorts, like operating within the big broadline distributors. Like, what do you think the core competency of this business is?
Yes, I'll say two, if I'm allowed to have two secret sauces. One is the platform, like you mentioned. I think it's pretty unique that when we bring on a vendor, the real selling point to them is we're not just reselling your goods, which is most of the conversations they have. We're going to put your goods for sale on all of these big distributors' websites. We're going to put them for sale on Amazon. We're going to cross-sell them to our Gate Gourmet business and our local Chicago restaurant customers. And with just one vendor agreement, we're going to really open up the entire United States to you as a vendor and be able to scale that quickly. And I think that kind of a platform approach is pretty unique in the entire specialty food space. Most specialty food distributors do the same thing they've been doing for 50 years, which is they come to work and they sell to restaurants local to their business, right? So it's a brand new sales channel for those we're working with. So the platform is unique first. Second, though, I think is our ability then to find, vet, and train those vendors. So, it's interesting as we watch. I get the question all the time, is there a risk that US Foods comes and steals these vendors from you? Sometimes we lose a vendor to US Foods, and that's just the way the game is played, right? Like if a vendor gets big enough that it makes sense for US Foods to have a direct relationship with them, then I expect to lose them, right? So I talk to the team all the time how important it is that we're constantly prospecting and finding kind of the next big thing for us that US Foods is not going to want to deal with yet, right? So I can't tell you how many of these vendors we have to teach them how to get the right food safety certifications so that we can make sure they're going to handle the food properly to get into the supply chain we've built for them. We teach them how to pack a box and then ship it with FedEx. I've told the story before of a new seafood vendor that we brought on that we ordered samples from them, and they didn't fill the void in the box that they shipped in. And so our sourcing guy literally got this box dropped on his doorstep with fish juice, oozing out the side of it, right?
Nice.
They hadn't taken care of it correctly, right? But it was perfect because now we knew what they needed. and we could actually like walk them through how to pack a box appropriately, how much ice was needed, and how to make sure that it stays cold all the way to its destination. And the second set of samples came through great, right? So like that's the kind of stuff that these big companies aren't going to mess with, and
Sure.
we've sort of built the apparatus to do it at scale, and then take each of these small vendors and give them this big platform. So those are kind of our two things I would focus on.
And if we take a step back and think about the total addressable market here, and there's this specialty food subsegment within the food service industry, talk to me about secular tailwinds or headwinds associated with this specific category.
Yeah, so the first trend I'd point to is food away from home. So the USDA actually tracks this, and it's fascinating because that metric, the percent of dollars that we all spend at the grocery store for food at home versus at restaurants, fast food places, other whatever to eat away from home, that percent of food away from home has been growing for literally 50 years. And it used to be that people ate 90% of their meals at home, and that just keeps shifting over time. We crossed over 50% like 10 or 15 years ago, I want to say it was, and it's just continued growing since then. Of course, COVID wildly messed with those trends, but we're really just back on the same trend line again now. And so, I don't think anybody expects that to abate, as people look for convenience, and they look to explore new flavors and cuisines and everything else. So that's kind of the first big secular tailwind. The second I would say is the way that Americans' tastes continue to evolve. So we as Americans, we've really gone from like a meat and potatoes society to like a Wagyu beef and tabbouleh society, right? Like we're looking for like interesting new flavors and cuisines and international focus, and spicy foods, and just a break out of the routine, and kind of like the famous casseroles that made up America 50 years ago are kind of not what people want to eat anymore in general. Of course, that's a big generalization, but as an industry, there's definitely a shift towards specialty. And it's interesting because if you go read the earnings reports from the big distributors I mentioned, from US Foods and Cisco, et cetera, they all talk about the growth in independent restaurants, which I think is related to the same trend, right? Like people are over time moving their spend away from the big chain restaurants that we're all familiar with and into smaller independent restaurants who offer something unique. So anyway, I think this company hits on all those right trends that match up with how consumers' tastes are evolving. And then I'll finish by just saying, if you look at even this retail business that we're building now in gourmet cheese, it's funny because the cheese category, most retailers used to just have like cheddar and mozzarella, right? And now the cheese category also contains things like Gouda and halloumi, and like all kinds of, like, I'll call like one concentric circle out from the basics. And so as we built this gourmet cheese assortment now with this retailer, we intentionally avoided like that core cheese main category. And the stuff we're putting in there is just cool. There's a truffle Gouda, and there's a blueberry Stilton, and there's a caramelized onion cheddar. Like it's just like I don't think that kind of stuff would have sold in a mainstream grocer a decade ago, and today it's flying off the shelves with our 10 store tests we've done, and now we're going to be hitting on the gas in a big time this fall. So I think just even that is sort of evidence of kind of how specialty food is playing for consumers.
And you've come in with the role of chief executive officer, but also chief capital allocator, and you've decided where to spend and where to divest. And so I think you've highlighted retail, and in addition to that, professional chef are the places where you think are worthy of continued investments and where you think the growth are. Maybe just maybe you talked about the retail a little bit, but maybe talk about professional chef and where that fits within everything that we've already discussed, and why it's worthy of continued investment.
Yeah, it's funny because I told this story on our recent earnings call too, but my business card used to have all these logos on the back of it for all the different entities that we owned. And a couple of weeks ago, when we finalized the iGourmet sale, I went through and I was like, oh my gosh, we have Food Hatch we closed down, Haley Group we sold off, Grow Brand Management we sold off, Plant Belly we gave away, Mouth.com we shut down, iGourmet we sold, and we're down to like 4 entities now that make up the core of the company. And it's our criteria for all those divestitures was, are they currently profitable? One, and two, where do we think they go in the future, right? And every single one of them either were already losing money or they were just flat and had no real future potential as we were able to assess it. And so, it felt like the whole company was spread so thin across so many initiatives, and we needed to just really focus in on the things that would drive profit for the company. I remember early on, I met a bunch of my team for dinner in New York, and we were kind of this is in the days when we were still sort of assessing iGourmet. So we were sort of brainstorming ideas for how to drive more repeat for the business. And the table came up with an idea. Everybody wanted to do a gourmet cheese advent calendar for the holidays, which sounded really cool, right? I was like, that sounds kind of fun, right? Like, how would you guys do it? And the more I heard them talk, I was like, this is going to take way more time than it's worth, right? So I didn't tell them that answer. I actually walked them through. I was like, hey, how about everybody at this table, tell me how many hours do you think you'll have to spend to design the packaging, to source the cheese, to build the website around it, to build out the marketing. And we actually like added up the man hours around the table. And then I said, well, if you think, what is like your pie in the sky number for what it could do in terms of revenue? And they guessed that, if it was really successful, we'd sell 500 units, at $100 a piece. And so we're like, okay, it's going to be 50 grand in revenue. And when you subtract out all the expenses we just talked about, like cost of goods expenses, we're going to be looking at like maybe $5,000 or $6,000 in profit. And then I literally did the math for them. We divided it by number of hours around the table that we just articulated. And I was like, do you guys want to work for $1.23 an hour for the next, 3 months to get this out the door? And we're all like, oh my gosh. And it was like mind blowing, the team, that because like it's just so easy to get caught in these traps of like constantly chasing new ideas all the time and not like really building a sustainable, impactful business. And so for the first 6 months in the role, first I had to design a leadership team. Like there was no leadership team in place when I got here. And the leaders of all these entities like hadn't even met each other before. And so we had to have like start staff meetings and actually get people to start working together. But then in those staff meetings every week, I'd ask them, we called it our laser focus meeting. And I said, tell me the 3 things you're going to accomplish this week. And we would use it to like really pressure test, like, is that really the most important? Like we said, these are our strategies, our most important priorities as a company. How do those ladder up? That doesn't sound like we shouldn't be working on the cheese advent calendar right now, right? And it was interesting because the more we did that, the more people like they really caught the vision of there's actually strength in saying no to things, right? And we're going to laser focus on professional chef because that's where the profit is. And we're at the time, still today, we're sitting at like US Foods is still 50% of the company revenue, right? So a huge concentration there. And it's why I've put such a focus on adding new customers, which we've done. In the last few months, we've added Cheney Brothers, which is a Southeastern broadline distributor. And then we said another top 5 broadline distributor we got to sign on as well. So the first new customers in 7 years for the company.
Wow.
On the dropship business. So that they'll take time to ramp, but like that's the kind of mentality we need to have is each of those are, potentially tens of millions of dollars of revenue opportunity. And compared to, 50 grand that we could get on a cheese advent calendar. So I like cheese a lot and I like advent calendars, but it's not the right focus for the whole company when we've got the size of opportunities that we have in front of us.
Yeah, that focus on materiality.
Yep.
And prioritization and triage is hard, right?
Yeah.
Until there's a framework in place. That's really interesting. And so I've seen from your presentation that the company has a goal of getting to 100 million in revenue and $10 million of EBITDA. Talk to me a little bit about what needs to happen for you and your team to achieve that goal.
Yeah, so I would say right now we are highly focused on getting this retail business stood up successfully. So there's just no room for any error when you're dealing with a customer this big.
Yeah.
Um, we are hitting on all cylinders and are going to knock it out of the park. And that's going to be it is going to completely change the company over the next 6 months. Um, the benefit to retail as opposed to food service is that it scales immediately. So we said in the press release that we're going to be in several hundred stores. That will happen. We'll go from literally the 10 stores we're in now on the test to the full set of assigned stores in 6 weeks.
Wow.
Right. So we're filling a pipeline with the inventory, and then based on what we're seeing in the tests, like we will immediately scale sales to those several hundred stores. And whereas the broadline distributor we brought on this spring, that's a top five distributor, that's going to be a like multiple years long ramp.
Mm.
It takes time to. We're a marketplace seller, right? So the stuff is essentially lost on the website until somebody discovers it and starts ordering it and does so regularly and there's not even a way to market it really, right? Like it has to come through partnerships with their sales teams and trying to build awareness little by little of these new products, and it's a long, slow slog, worth it in the end because it's the most profitable thing we do as a company, and so it's not an either or, it's an and. But I'm excited about this retail business because it's going to scale so incredibly quickly. So that's number one. Number two is we've got to get these broadline relationships back to growth. So they've been lagging flat to declining over the last really since like the month before I got here is sort of when that trend started. And so we've got a good plan in place, but getting back to like mid to high single digit growth is going to be really important because that's the cash engine of the entire company. So we've said publicly we expect that business to get back to growth here in the back half of this year. So we've only, of course, released Q2 so far, but Q3 and Q4 should show growth. So that's number two. Number three then is our M&A strategy. So we can talk about this more, but I really want to have a thoughtful and measured approach to bringing on some conservative acquisitions in the next 12 to 18 months that can help us do essentially what we've done with Artisan and sort of vertically integrate in a way that can grow those businesses more. So we can talk more about that, but that's the third big bucket. And then the last and fourth, I would say, is to sell our Pennsylvania warehouse. So we've got that up for sale right now to do a sale leaseback.
Mm.
And our cost basis on that warehouse is $6 million. And while it's appraising for 18. And so, for a company like us to sit on that much equity when it's a 210,000 square foot warehouse and we're using about 50,000 square feet.
Oh, wow.
So half of it is leased out to somebody else right now. A quarter of it we're using, the other quarter is sort of sitting empty. To me, that's not the right way to use our capital. We should be using it to grow and
Sure.
not to kind of sit on real estate. So the goal is that we do a sale leaseback there, so the operation stays in place, but we're able to exit the actual ownership of the building, and then we have a $9 million loan on it. It's the only like large long-term loan as a company. So we would essentially pay off the loan, be debt-free as a company, have 3 to 5 million left in cash after the loan is paid off, and have a nice war chest to continue down our path with M&A. I think that's our story is going to be pretty phenomenal at that point as we're growing double digits, we're profitable, debt-free, and exciting prospects ahead.
So let's dig into the M&A side a little bit. I'm just trying to think about the benefits of vertical integration. So maybe let's start with that and maybe weave in the what the profile of a good acquisition would look like. Assuming you have the balance sheet capacity to do it.
Yeah. So in my mind, it's all about the synergies, right? Like if we can't bring synergies to the acquisition, then investors might as well put their own money into an acquisition, right? Like we have to have something special that we're bringing to the acquisition that makes 1 + 1 = 3, right? Um, so what we saw happen with the Artisan acquisition a decade ago in Chicago was, they were already a vendor to us, like I mentioned, but they were essentially pushing two businesses through a single warehouse, right? They had a local distribution business like any other specialty distributor, but then they had this shipping business where they would ship out to the drop ship customers of US Foods. And both sides of that business have essentially doubled over the decade we've owned it. So we now do about $20 million out of that Chicago warehouse. About 10 goes to our drop ship customers, and about 10 goes there locally to restaurants and caterers and such. Um, that's a great business model because you get significantly better throughput when
Sure.
you're selling the exact same assortment to two completely independent sales channels. And so you're sweating the asset way better than the average specialty distributor would be able to. And so with that dynamic in mind, I think we could do that again, but maybe vertical integration is the wrong term to use here because I'd like to go after players that we don't have a relationship with today. So
Sure.
in particular, focusing on categories that we don't currently have much of a presence in. And what that would do is enable us not only to, I call these bidirectional synergies, right? There's a synergy of we immediately onboard that distributor's assortment to our dropship channels. We grow our assortment on dropship and make more money there. And in turn, the distributor that we bought is getting the better throughput. But then simultaneously, we ask the new distributor to cross-sell our dropship assortment to their existing customers in their local market, right? And so I think those are all hypotheses. And so it's important to me that, and this gets into the criteria, that our first acquisition or two are small. I want to do it with no dilution is my first requirement, because I think that gives us space to learn and to deploy the capital in a way that if the synergies don't play out exactly the way I'm hoping, that we've still invested in a profitable, healthy, good business that doesn't, destroy the company. I don't want to bet the company moves on a first acquisition like this, right? Which leads me to the second point, which is it has to be profit accretive from day one. I don't want to buy troubled businesses that we think we can turn around or that need significant capital or investment to make it work. I want to buy like healthy, profitable businesses that we can help bring these synergies to, like I mentioned. Three is a fair price. So we're looking at companies where we can pay 3 to 5x adjusted EBITDA. And we've passed on a lot of really cool opportunities that were wanting a higher multiple than that. And again, at like our stage, I don't know that I want to take that kind of risk yet before we've demonstrated that we have a good playbook for integrating acquisitions and driving the synergies, right? Um, so that's three. And then I already mentioned the no dilution. That was number four, or that was number one. So then the fourth one would be that we have clear synergies, which we kind of already talked about, right? I don't want those to be part of the fair price calculation, right? We're calculating price and value based on no synergies, but I want to have these clear hypothesized synergies that we're going to chase as soon as we get the whole business integrated into IVFH. So those are kind of the four main things that we're looking at. And I think that, when we find the right opportunity that meets those criteria, it's going to be a slam dunk for the company and for investors. And my hope is demonstrate a really cool playbook that we could then go replicate over and over again in the future as the company grows.
And does owning more of your own brands, does that present any channel conflict or partner conflict? I mean, are you muddying the waters in certain places that's a risk factor there, or is there a structure which mitigates that?
I mean, we're always really careful to not step on the toes of our big distributor partners. And the way we think about that is everything we do should be complementary, not competing with them. Now, we have a brand that we put on products in Chicago, the Artisan Specialty brand, that we sell on our distributor partner sites. We also sell those locally through the Artisan salespeople.
Sure.
So, I mean, if that's what you mean, then yes, sometimes those brands will end up like head to head with one restaurant, but it doesn't happen very often. I mean, I should have said this at the outset, but this whole space, the whole industry is extremely fragmented. You've got those three big players, but they make up, I think it's still less than 50% of the entire market.
Mm.
And after that, like the Pareto curve of competitors falls off dramatically. And so because of that, like it doesn't happen very often that we're running head to head, and we tend to give the distributor preference anyway because we're still going to get the sale and it maintains the relationship. So it's really an opportunity for us to build new or different or incremental relationships where the broadline partners maybe don't have as big a presence.
In that relationship with the broadline customers, there's a big mismatch in terms of their size and your size.
Yeah.
You talked about this companies maybe didn't have the muscles to take pricing in the past. How have you assessed your ability to continue to push pricing, especially given that mismatch between, and I know he's selling through a marketplace, but there's still these guys are still the kind of the Walmarts of the world, and you work for Walmart, so they're one of the probably the hardest on their suppliers of anybody, I guess, is stereotypically. So how do you balance that, kind of that need to be a really good partner to those customers with, getting the fair value for your sourcing and then the platform that you're running?
Yeah, so that's a good question. And it's why I kind of emphasized early on that when we first took pricing, when I first got here, we were really just catching up, right? So we weren't trying to margin up. We were trying to return to the margins we'd been at. And I think there was a broad understanding of that in that inflationary environment of the time. I've been vocal in public before that we're not going to grow profit through margin growth over time. My goal is not to keep raising prices on our customers. We're essentially a middleman, right? And we're buying from vendors and then reselling to another distributor. So there's not room for us to just keep raising margins. It ruins when you have multiple margins being put on top of your prices after you sell it. You end up ruining the value proposition for the end customer if you're too aggressive about that. So when we're at our normal run rate of margins, we make plenty of money. And my goal is that we grow bottom line through revenue growth at that point, right? Through revenue growth and through leveraging the expenses. Because like I said, like with an asset-light business like this that scales so easily, we should be able to leverage expenses extremely well over time. For instance, this broadliner we brought on this spring, we literally only hired one person, just an account manager to take care of it. We don't need a whole customer service team. We don't need a tech team. We don't need warehouse people or trucks or anything, right? Because it's a drop ship business. It literally just plugged into everything else we're already doing. And the only expense is the one salesperson. So I think that kind of a model is how we're going to exponentially grow profit over time rather than trying to increase gross margins.
And given the role you play sourcing of specialty foods and ingredients that are probably working with vendors that are too small for the broadline players to work with, are you on all of their marketplaces? Why wouldn't, I mean, what's the cost to them to have someone who, is a decent sized player, as an option on their internal marketplaces? Talk to me a little bit about that dynamic.
Yeah, first of all, they don't all have marketplaces.
Got it. Okay.
It's definitely like a growing space. I mean, US Foods launched theirs a year and a half ago.
Got it.
Cisco launched theirs 6 months ago. Cheney Brothers launched theirs 6 months ago, right? So like it's kind of a new and growing space for broadline distributors because of all the dynamics that we've talked about. Like they all want to be able to sell more items without needing bigger warehouses, right? Or incurring more waste. And so there's an important role for these marketplaces, but I think that the conversations we have is like, we were kind of a marketplace before marketplaces were cool.
Mhm.
We've been doing it for 20 years. And so you can work with us and onboard, 8,000 items immediately, or you can go work with like dozens or hundreds of vendors on your own and try to do all the food safety vetting, all the, vendor agreement negotiations and all of that hundreds of times. Like we've got a ready to go, fully baked marketplace with, most categories already covered that we can help them scale really quickly. And frankly, like you know, of course, we need to make money along the way too. But the fact that we're working so far up the supply chain, our goal is always to get right to the source, right? So we're
Sure.
literally working with the fisherman, with the rancher, with the producer of a packaged good product. And so cutting out all those other middlemen helps us to still deliver a competitive price, even though we need to take a cut along the way too. So yeah, I think that's the value that we bring to these big broadline distributors and why they want to work with us.
And we can't leave any conversation with a public company CEO without discussing culture. I'm curious about the culture that you inherited, and then a little bit, I'd love to hear about any additional cultural elements that you're trying to embed deeply into the organization.
Yeah, sure. So it's interesting. I kind of mentioned this earlier, but the entire company had really been operated as completely disparate, separate entities, like a holding company, I guess, right? But to me, for a 70 million, $80 million revenue company, that didn't make sense. It felt like we had um, really like deleveraged the management structure and the oversight and the the growth potential because all the businesses were operating so independently. And like I mentioned at the beginning, I had to actually like have people meet for the first time because the leaders of those various entities didn't even know each other. So, we've had this rallying cry from day one, called One IVFH. And our goal is that we operate together as one team. The entity structure is a legal structure. And, certainly there are different P&Ls that somebody might be in charge of, that different people might be in charge of, but we want people to work together and think like, hey, I manage XYZ business, but I just found this cool item that could really help them over there. And we have a relationship. So I'm just going to pick up the phone call, pick up
Yep.
the phone and call and tell them, hey, I'll bring this into my warehouse because I have one customer, but this might benefit you guys too. It was one of the things we did very early on. There was no bonus program in place when I got here. And, coming from big companies, that was sort of odd to me. Bonuses had been just 100% discretionary. So there was no like, their bonuses were
Metrics
given out.
or yeah.
There were no metrics. There was no consistency across teams or across leaders, and that had engendered a lot of frustration by people who felt like they'd done good work and not received bonuses. And so that was probably one of the first things I did in like the first 4 weeks is we established metrics, but that first year in particular, we said we're doing one set of metrics for the whole company. We want it to reflect the one IVFH mentality, and we're all going to win or lose together this year. And stop, protecting your turf and not thinking outside the box and not thinking about how there are downstream implications to somebody else if you choose to make whatever decision. And it was like magic, man. And we had a fantastic first year. We got good bonuses, and the way that just changes the whole morale and gets people working together and excited about the direction we're headed was really, really incredible. The other thing I'll add though is we had a big town hall meeting with the total company just last week because we're at this turning point now. Once we've now sold off iGourmet, where we're kind of done with the cleanup work, right? Like anything that was going to be sold off or closed down has been done, and we're now building this new retail business. So it feels like a new day for the company, and so I used it to actually instill like a more formalized culture that I've been wanting to do for a while, but it's hard to do that when you're still closing stuff, right? It just comes across as disingenuous. So, now that we're kind of at that point, we put in place a mission statement, we put in place a vision statement, we came up with 10 corporate values. we started a program we're going to call IVFH University. And every month as a whole company, we're going to take one of those corporate values and dive deep into it.
Mm.
And we assign some homework, some TED Talks, a book to read, and we're just going to like slowly like grow the company's lexicon around each of these values and like get people talking and interacting and learning and implementing behavior change with kind of where we want to take the way that the company does work, the way that we approach our culture. So lots of work to do still, but pretty excited about the way that we're going to keep pivoting on the company culture.
Could you highlight one of those values that you think really speaks to what you want people to, learn and kind of absorb over hopefully a short period of time?
Yeah, it's funny. I'm looking through them, and I've actually mentioned a lot of them already because it's just part of my like laser focus, and we're chef driven and things like that. But two I'll call out is the one we're focused on this month for IVFH University is an innovation mindset. So we actually, as a group on the town hall, we watched a video about the Utah Department of Transportation and how they completely changed the way that they build bridges in the
Mm,
state. And it used to take 18 to 24 months to build a bridge, which is kind of normal everywhere. And it completely disrupts traffic for a long time, right?
sure.
And whoever was leading the group at the time, fantastic idea, said, what if we had to do it in a weekend? And it got people actually thinking about it totally differently. And they said, well, we'd have to build it right on site next to the current bridge and then like slide it into place on wheels. But that sounds stupid. And the leader was like, why does that sound stupid? Let's do it, right? And they actually like pioneered this totally new way of doing bridge construction. It's actually called now ABC, Accelerated Bridge Construction, and everybody across the nation does it the way that UDOT started it out. And so we watched a video about that, and we talked about like embracing constant change and continuous improvement. And it doesn't matter what your role is in the company, from a cheese cutter in Pennsylvania to a warehouse worker in Chicago to our accounts payable person or whatever, right? Like everybody should be looking at their job every day and thinking about how do I make this faster, more efficient, whatever. We actually got a question after we always do like an open anonymous Q&A after our town halls, and somebody asked, well, what's the incentive to do that? Because you'll just work yourself out of the job. And I was like, what a great question. That's exactly how I feel, actually. I would love you to work yourself out of a job. That's how people get promoted around here. That's how they're going to get raises. That's how you get recognized, is by like automating, bringing in some new software, like figuring out a new process. Maybe we outsource it to a third party. Like work yourself out of a job. That's the mindset we want, is that we want to keep becoming more efficient and not add headcount to grow. We want to grow because we're getting smarter every day. So anyway, that was one. Second one I'll highlight is just, we call it own the outcome.
Mm,
So there was this famous article in the Harvard Business Review back in like the 80s, I think it was, called The Care and Feeding of Monkeys. And it's all about like, sometimes leaders actually train their people to give them their monkeys. And the whole article is about like, you have to give the monkey back, right? Don't take other people's monkeys. Don't let it, perch on your own back. And so the whole conversation is going to be around how do we train people to take ownership all the way to the end, right? So
mm,
if you're in charge of this business, own it, right? Like don't bring problems to your boss. Like own the outcome. In a way, we're going to read an excerpt from the book. I think it's called The Founder's Mentality. I read it years ago and loved it so much, right? It's the idea you're the owner of this business.
yep.
The buck stops with you. There's nobody else to lean on. So anyway, that kind of stuff is what we're going to be working through with the corporate values.
Well, I'm really curious to see how that turns out because there's been a lot of change. There's been financial change, there's been organizational change, there's been operational change, and so people have been to some extent become acclimated to a fair amount of change, and so hopefully they're open, kind of prepped and open for cultural change as well.
Yeah,
And
definitely.
so this has been great. We've talked about a lot of things. We've talked about profitability. We've talked about growth. We've talked about new business lines. We talked about culture. We'll close with this podcast with a question we ask all of the CEOs we have on, what do you think is the most underappreciated aspect of innovative foods?
The most underappreciated aspect. I would say that, and this is something I mentioned earlier, but I'll drive it home. The asset light nature of our core business. There are not many businesses built that way, right? Most businesses need a constant infusion of capital to keep growing. And we're seeing that right now in the retail business. That part is not capital light. And we're spending a ton on working capital right now to buy cheese and import it from Europe and to buy machines and put them in place. And we're going to get great returns on it. So I'm excited about the business. But the more we can get that core dropship food service business to meaningful growth is what's going to help us print money, right? I mean, it's when I don't need to add people or warehouses or trucks or anything to grow that business. The P&L is just going to continue to accelerate as we can grow that business, and I'm pretty excited about that.
Yeah, I mean, it's precisely why I asked the question about being on everyone's marketplace, because if there's little incremental cost, maybe one salesperson, that person can handle an enormous amount of revenue, right? Because of the capital light nature. So that seems like an exciting thing, especially if there's a kind of a wave of new marketplaces coming along as the big broadline guys recognize that they just can't deal with a cattle vendor in Idaho or something like that that isn't particularly big. Well, wonderful. Thank you so much for being on Compounders. This has been great. I think what the best thing that people can take away from this is the context of what you came into, what's changed, and kind of what it's looking like going forward. I think we covered all of those things.
Yeah. Thanks so much, Ben. I appreciate it.
Yeah, Bill, thank you.